The Bank of Canada stands as the cornerstone of the nation's financial system. As Canada's central bank, it plays a crucial role in shaping the country's economic landscape. Its responsibilities go far beyond simply issuing currency. The bank is tasked with developing and implementing monetary policy, ensuring the stability of the financial system, and fostering confidence in the Canadian dollar. Every decision made here has a ripple effect across the entire economy, influencing the daily lives of Canadians from coast to coast. Established in 1934 during the Great Depression, the Bank of Canada was created to help guide the country through economic uncertainty. Its founding mission was, and remains, to promote the economic and financial welfare of Canada. Over the decades, the bank has evolved, adapting to new challenges and expanding its role as the nation's economic guardian. The bank's core functions include managing inflation, controlling interest rates, and overseeing the money supply. By carefully monitoring economic indicators, the bank works to keep inflation low and predictable, which helps Canadians plan for the future and maintain their purchasing power. The bank also communicates its decisions and outlook to the public, ensuring transparency and building trust in its actions. Regular updates and press conferences help Canadians understand the reasoning behind key policy moves. By adjusting interest rates, the bank aims to create a stable environment that encourages economic growth and supports employment. These decisions are made with careful consideration of both domestic and global economic trends. Keeping inflation in check while stimulating the economy is a constant balancing act. The bank must weigh the risks of rising prices against the need to support businesses and households, making its role both challenging and vital. Interest rate changes are the bank's primary tool for managing economic activity. By raising or lowering rates, the bank can influence borrowing, spending, and investment across the country. These decisions have a direct impact on Canadians' everyday lives, affecting everything from mortgage rates and car loans to the cost of starting or expanding a business. The bank also plays a role in educating the public about financial literacy, helping Canadians understand how monetary policy affects them and why stability matters. In a rapidly changing world, the bank must stay vigilant and adaptable, constantly monitoring new risks and opportunities to support long-term stability and growth for all Canadians. The Bank of Canada faces a tough and delicate choice, whether to hike or cut interest rates in the face of mounting economic pressures. Every decision carries significant consequences for households, businesses, and the broader Canadian economy. The stakes are high, and the path forward is anything but clear. By holding the policy rate steady at 2.25%, the bank signals its recognition of the complex and often contradictory signals coming from today's economic landscape. Inflation remains a concern, but so does the risk of slowing growth. Markets are sending mixed messages, and unpredictable global events, from geopolitical tensions to supply chain disruptions, add further layers of uncertainty. Policymakers must weigh the risk of acting too soon against the danger of waiting too long. The bank's cautious approach is intentional. By pausing, officials give themselves time to monitor new developments, analyze incoming data, and consult with experts. This period of observation is crucial, as the Governing Council must be prepared to respond quickly if new shocks emerge, or if inflation takes an unexpected turn. Their vigilance ensures that policy remains flexible and responsive to changing conditions. Exercising patience helps the bank avoid making hasty moves that could inadvertently destabilize the economy. A premature rate change could trigger unintended consequences, affecting everything from mortgage rates to business investment and consumer confidence. The bank's current stance mirrors a global trend among central banks, prioritizing stability, careful analysis, and adaptability in the face of ongoing uncertainty. In these challenging times, a measured approach is often the wisest course. Keeping inflation near 2% is central to the Bank of Canada's policy. This target supports economic growth and preserves purchasing power. It guides interest rate decisions, balancing stimulation with inflation control. A steady 2% fosters predictability for businesses and consumers. Too much inflation erodes value. Too little signals weak demand. The target also builds credibility and transparency, managing expectations. Achieving it requires careful maneuvering amid domestic and global pressures. The 2% goal remains the bank's anchor for economic stability. The Bank of Canada faces a complex landscape shaped by unpredictable U.S. trade policies and ever-changing economic data. As the world's largest economy and Canada's closest trading partner, the United States wields enormous influence over Canadian economic fortunes. This relationship means that even minor shifts in U.S. policy can send ripples across the border, creating both opportunities and significant challenges for Canadian policymakers. Canada's close economic ties to the U.S. mean that changes in American trade policy, such as new tariffs, renegotiated agreements, or sudden regulatory changes, can quickly impact Canadian exports and industries. The flow of goods, services, and capital between the two countries is deeply intertwined, making Canada especially sensitive to shifts in U.S. priorities. Tariffs and regulatory shifts can alter export dynamics overnight, affecting everything from raw commodities like lumber and oil to high-value manufacturing sectors such as automotive and technology. Canadian businesses must constantly adapt to these changes, often with little warning, which can disrupt supply chains and investment plans. For many Canadian companies, this means reevaluating strategies, renegotiating contracts, and sometimes seeking new markets to reduce dependence on the U.S. These adjustments require agility and foresight, as well as support from policymakers. At the same time, fluctuating economic data, both domestically and from the U.S., makes it increasingly difficult to assess Canada's true economic health. Key indicators like employment, inflation, and GDP growth can swing rapidly, influenced by global events, commodity prices, and policy decisions abroad. Strong quarters driven by surges in oil exports or resource prices can be followed by contractions in other sectors such as manufacturing or retail. This volatility complicates the Bank of Canada's efforts to set stable monetary policy. The uncertainty is further amplified by global economic trends and the unpredictable nature of international trade disputes, which can affect currency values and investor sentiment. U.S. policy changes also have a direct impact on investor confidence and market stability in Canada. When American leaders announce new tariffs or hint at trade renegotiations, Canadian markets often react immediately, with stock prices and the Canadian dollar experiencing sharp movements. Uncertainty south of the border can trigger volatility in Canadian markets, making it harder for businesses and households to plan for the future. This environment of unpredictability can dampen investment and slow economic growth. The Bank of Canada must stay nimble, monitoring these developments closely and responding quickly to new information. This requires a careful balance between reacting to immediate risks and maintaining a long-term vision for economic stability. Adjusting policy to mitigate external shocks, whether from trade disputes, commodity price swings, or financial market turbulence, is crucial for maintaining stability and supporting growth. Through proactive planning, collaboration with international partners, and a commitment to flexibility, Canada can better weather the storms of global uncertainty and continue to build a resilient economy for the future. The upcoming USMCA review brings uncertainty for Canadian business investment. As a key trade pact, USMCA shapes tariffs and regulations across North America. The 2026 review could change trade rules, making companies hesitant to invest. Sectors like automotive and agriculture are especially vulnerable. The Bank of Canada must factor these risks into its policy decisions. Shifts in trade terms could affect GDP and jobs, requiring careful planning. Canada must stay ready to adapt as global trade rules evolve. Recent Canadian growth was fueled by a surge in oil exports and increased government spending. Oil, a major export, makes Canada's economy sensitive to global price swings. Government investments in infrastructure and services boosted jobs and confidence. However, reliance on oil exposes Canada to market and policy risks. Higher government spending raises questions about long-term debt. Balancing these factors demands close coordination of fiscal and monetary policy. The bank must support growth without fueling inflation or fiscal imbalances. Its guidance is vital as the economy navigates these volatile forces. Despite the bank's caution, financial markets are making their own interest rate predictions. Many expect a 25 basis point hike in October 2026, reflecting a trend toward tighter policy. Market forecasts rely on inflation, employment, and GDP data. A rate hike would signal confidence in economic recovery. However, markets and central banks don't always align. The bank weighs market sentiment but bases decisions on comprehensive analysis. Clear communication helps manage expectations and reduce volatility. Balancing market views with policy goals is a constant challenge. The Bank of Canada is taking a cautious stance amid economic uncertainty. Holding rates at 2.25% provides stability while more data emerges. This approach lets the bank assess impacts of trade, inflation, and domestic trends. Flexibility is key. Unexpected events can quickly shift the outlook. The bank's careful monitoring ensures policy shifts are evidence-based. Balancing competing priorities requires vigilance and adaptability. The bank's commitment to caution supports long-term economic health. The Bank of Canada's rate dilemma highlights the complexity of modern economic management. Holding rates reflects a strategy of stability and data-driven decisions. The 2% inflation target remains central to supporting growth and stability. The bank must stay adaptable, as factors like USMCA, oil, and government spending evolve. U.S. trade policy will continue to shape future directions. Clear communication with markets is vital to prevent disruptions. The bank's choices will shape Canada's economic path. Prudent, flexible policy is essential for the nation's prosperity and resilience.